1 minute ago, the CME Group's daily delivery report updated. Buried inside a table that fewer than 1,000 people on Earth truly know how to interpret was a number that reframes everything you thought you understood about the silver market. A number that has never once been shown on financial television. A number that does not trend on social media. But it matters. JPMorgan is aggressively standing for maximum physical delivery. Not 6 months ago, not during some quiet accumulation window when no one was paying attention. Right now, on first notice day, in the most scrutinized silver delivery cycle this exchange has seen in decades. The largest bank on Wall Street, the same institution that spent 15 years as the dominant short in this market, same institution that paid nearly $1 billion in manipulation fines in 2020, just filed delivery notices for 12 million ounces of physical silver. And the real question is not whether it happened. The report confirms it. The question is why. What does JPMorgan see that it is not saying publicly? What is it positioning for? And why is it doing this now, in this delivery window, under this level of scrutiny? The next few minutes are not about price targets. They are not signals. They are not predictions wrapped in drama. This channel has never charged $1 and never will. If you are here for one reason: to understand the structure before the move becomes obvious. This is John OG. January data already showed something abnormal. JPMorgan issued the overwhelming majority of delivery notices for over 8 million ounces through more than 1,000 contracts. But that was not the anomaly. Open interest increased while deliveries were being processed. Read that again. In a normal market, when a contract settles into physical delivery, open interest declines. The paper claim disappears. The bar changes hands. The position closes. But January saw delivery and expansion at the same time. That is not random behavior. That is not passive vault management. That is an entity that wants more metal than the visible market can supply without forcing price higher. This is accumulation through delivery. The most transparent, documented, and irreversible way to convert paper exposure into physical inventory inside a regulated exchange. And it was happening during margin hikes that forced speculative longs out of the market. Paper price was pressured lower, while physical was quietly absorbed. Estimates suggest JPMorgan's total physical silver holdings could exceed 750 million ounces, accumulated largely between 2012 and 2019, when silver traded between $14 and $20. If those numbers are even close to accurate, the unrealized gains are staggering. And yet they are not distributing. They are adding. Today's 12 million ounce notice does not stand alone. It sits inside a broader structural pattern. For roughly 16 months, large institutional players have been standing for delivery, while volatility events and margin adjustments cleared out leveraged participants. Each price flush transferred metal from weak hands to strong balance sheets. February marked controlled futures, participation, and steady delivery acceptance. March is projected to bring volatility expansion and lease rate stress. The timeline aligns. The 12 million ounce filing today is not the beginning. It is the continuation of a sequenced repositioning. Now let's apply discipline. Verification matters. The 750 million ounce estimate is derived from vault data, delivery records, and custody reports, not from a public admission. The 12 million ounce delivery notice, however, is documented. That is fact. The exchange retains the authority to alter margin requirements at any time. It has done so before. Will do so again if conditions warrant. Rule changes are part of the architecture of commodity markets. Late last year, an outsized delivery demand strained the system. Registered inventory levels were thin relative to contract obligations. That stress was deferred forward into a later contract month. Deferred does not mean eliminated. Now we arrive at the present window. Silver is trading at historically elevated levels relative to its prior multi-year range. The gold to silver ratio has compressed. Registered inventory has declined significantly from previous peaks. Deliveries have drawn down stocks at a pace that requires conversions from eligible categories to meet demand. For decades, paper trading volume in silver dwarfed the amount of metal that could ever be delivered. The ratio between notional paper and physical inventory reached extremes that only functioned under one assumption. Most participants would settle financially. The system holds as long as delivery demand remains manageable. When that assumption begins to weaken, physical positioning becomes strategic. The institution that once benefited most from paper dominance is now one of the largest documented takers of physical delivery. That is not an emotional statement. It is observable behavior. Is this preparation for structural repricing, or is it sophisticated vault and client inventory management that appears directional from the outside, but is operational in nature? There are rational arguments on both sides. Observable data shows significant delivery activity. It shows inventory shifts. It shows continued participation during tightening conditions. What it does not show is motive. But motive can often be inferred from pattern. When an institution transitions from persistent short exposure to sustained physical accumulation over years, that is not a tactical trade. That is strategic repositioning. The paper-to-physical leverage that once defined this market depended on confidence in cash settlement. If more participants demand bars instead of balance sheet adjustments, stress increases. And in a stress scenario, those who hold physical inventory hold optionality. JPMorgan just removed 12 million ounces from the available pool on first notice day. Whether that represents preparation for repricing or disciplined inventory management is the debate. But the data is public. The reports update daily. The commitment of traders releases weekly. The vault stocks are posted in black and white. The difference between narrative and reality is verification. If you verify, you understand before the headline. If you wait for television to interpret it, you are already late. The map is available to anyone willing to read it. This is not hype. It is structure. This is not advice. It is awareness. This is financial warfare education. Verify before you act. Move with logic, not emotion. This is John O.G.